You remember the exact moment it started. Not with a strategy, not with a trading account. It started with a number on a screen that belonged to someone else. A guy in your college group chat posted a screenshot. Green numbers, a position that turned $300 into $4,000 in a single afternoon. He did not explain how. He just posted the screenshot and typed 2 words, easy money. You stared at that screenshot for a long time. You did not know what the chart meant. You did not know what the ticker symbol was. You did not know the difference between a stock and an option. But you knew what $4,000 meant to you at that point in your life. And something shifted. Something quiet and significant. The way a door swings open without making any noise. That moment right there is where almost every single trader who has ever existed begins. And what I want to walk you through today is not a trading strategy. It is not a list of indicators. It is something much more important than either of those things. It is a map of the 5 distinct levels that every trader moves through, or fails to move through, on the way to actually making real, consistent money in the markets. And by the time we get to the end of this, you are going to understand not just where you are right now, but why so many people who try this never make it past a certain point, and what specifically separates the ones who do. Because here is what the YouTube ads will never tell you, and what the trading gurus with the rented Lamborghinis will never explain. The reason most people fail at trading is not that they chose the wrong strategy. It is not bad luck. It is not the market being rigged against them, though they will spend years telling themselves that story. The real reason is something much more uncomfortable, and we are going to get to it. You open an account. The process takes 11 minutes. You deposit money, maybe a few hundred, maybe a few thousand, depending on how much that screenshot affected you. The platform is clean, the interface is simple, and the whole thing feels like an app you already know how to use. That feeling is intentional. That feeling is dangerous. You buy your first position based on something you saw on social media. Maybe it was a Reddit thread. Maybe it was a financial TikTok with 2 million views. Maybe it was that same guy from the group chat who has now started posting daily. The reasoning does not matter very much. What matters is that you are not making a decision based on any kind of edge or analysis. You are making a decision based on a feeling, and that feeling is called excitement. And in trading, excitement is one of the most expensive emotions a person can carry into a position. Some people lose money immediately. Their first trade goes against them, they feel the sting, and they either quit entirely or they get curious enough to ask a better question. Those people, strangely, are the lucky ones. The more dangerous outcome is winning, because if your first trade makes money, and sometimes it does, the market is indiscriminate about who it rewards in the short run. You do not learn that you got lucky. You learn that you were right. You learn that your instinct works. You walk away from that trade feeling like you have discovered something other people are too slow or too cautious to see. That confidence is not built on anything real, but it feels completely real. And that is all that matters at this stage. So you trade again, bigger this time, and the account goes. Either slowly, one emotionally driven trade at a time, or quickly, all at once, on a single position you were absolutely certain about. Either way, you are left with a very specific kind of confusion. The kind where you cannot quite explain what happened, because each individual decision felt reasonable while you were making it. Most people stop here. They decide the market is not for them. They tell their friends it is basically gambling. They move on, but a small number of people do something different. They get angry, not at the market, but at themselves. They think, I did not know enough. If I had known more, that would not have happened. And that thought, that one specific thought, is the door into the second level. You start studying, and I mean really studying, the kind where you have 17 browser tabs open at midnight and you are genuinely excited about what you are reading. You learn technical analysis. You learn about moving averages, RSI, MACD, candlestick patterns with names that sound almost ceremonial, the hammer, the engulfing candle, the evening star. You learn about support and resistance. You watch hundreds of hours of content from people who seem to have figured it all out. And you take notes on their strategies the way you used to take notes in school, as if the answers are in the material. And if you can just absorb enough of it, the results will follow. Your charts start to look different. Where you once saw a simple line moving up or down, you now see layers. Indicators stacked on indicators. Lines crossing other lines. You look at your screen and it feels, for the first time, like you are reading the language of the market rather than just guessing at it. And then you start trading again with all of this knowledge. And something quietly, miserably strange happens. You still lose. Not every trade. Some of them work. But the losses keep coming, and they do not make sense to you. Because you did the analysis. You followed the setup. The pattern said one thing, and the market did another. You sit with your charts after a bad trade, and you look for what you missed. And sometimes you find something, and you adjust. And the next trade still does not work the way it was supposed to. The studying feels like progress. The indicators feel like answers. But the gap between what you know and what you can actually execute in real time, with real money on the line, with your emotions firing in every direction, that gap does not close just because your knowledge increases. Knowing the right thing and doing the right thing, when money is involved and the market is moving against you, are two completely different skills. And one of them cannot be learned from a chart. Somewhere in the back of your mind, usually after another losing month, you begin to suspect that the answer you are looking for is not in another indicator. It is somewhere else entirely. That suspicion is the door into the third level. And the third level is where things get genuinely painful. In a way, that is much harder to explain than simply losing money. The trap between the second and third level does not look like a trap. That is exactly why it works so well. It looks like I have almost figured it out. You have been studying for months, maybe longer. You have gone through 3 or 4 different strategies, refined your approach, adjusted your entries and exits. And there are stretches now, sometimes a week, sometimes 2, where things actually seem to be clicking. A few good trades in a row. The account grows a little. You start to feel something different from the excitement of the first level. This feels quieter, more grounded, like competence building slowly, the way it is supposed to build. And then one trade unravels it. Not just the money, something deeper than the money. Because at this stage you have invested so much more than capital into this. You have invested months of your time, your identity, your belief that you are the kind of person who figures things out. And when a trade goes wrong at this level, you do not just lose a position. You feel like you are losing an argument you have been having with yourself for a very long time. So you do something that feels completely logical. You move the stop loss just a little further, just enough room for the trade to breathe. You tell yourself the thesis is still valid. You tell yourself the market is being irrational and it will correct. You sit in front of the screen and you watch the red number get larger. And you hold on, because letting go means admitting something you are not ready to admit. Sometimes the trade comes back and you feel vindicated. That vindication is the most dangerous outcome possible, because it teaches you to hold losers. And holding losers over a long enough timeline is how trading accounts die quietly. You take profits too early because the fear of watching a winning trade turn into a loser is physically uncomfortable. You hold losing trades too long because closing them makes the loss real. And as long as the position is open, some part of your brain still believes it might recover. You revenge trade after a bad morning, doubling down on the next setup. Not because the setup is good, but because you need to make the money back before the day ends. You know all of this is wrong. You have read about trading psychology. You understand, intellectually, every mistake you are making while you are making it. And that understanding does absolutely nothing to stop you. Because the problem at this level is not ignorance. It is identity. Somewhere along the way, being right became more important than being profitable. The trade stopped being a probability to manage and became a statement about who you are. And you cannot manage risk clearly when your ego is sitting inside the position with you. Most traders who are serious about this live at this level permanently, not because they are not smart enough to move forward. Because moving forward requires something that feels, from the inside, almost like self-destruction. It requires you to stop needing to be right. It requires you to treat a losing trade with the same emotional neutrality as a losing coin flip. It requires you to separate your identity so completely from your outcomes that a bad week does not change how you see yourself at all. That is not a strategy adjustment. That is a personality reconstruction. And most people, when they finally understand what is actually being asked of them, decide quietly that it is too much. The ones who do not decide that, the ones who sit with that discomfort long enough to move through it, they arrive at the 4th level. And the 4th level is where everything you thought trading was supposed to feel like finally begins to make sense. You will not remember the exact trade that marked the transition. There is no single morning where you wake up and everything has changed. It happens gradually. And then you look back from a few months later, and you realize the shift already happened without announcing itself. What changes first is your relationship with losing trades. A stopped-out position no longer ruins the rest of your day. Not because you have become indifferent to money, but because you have genuinely internalized something you previously only understood as a concept, that a single trade means almost nothing. What matters is the outcome across 50 trades, or 100, or 300. The edge does not live in any individual result. It lives in the consistency of applying the same process, over and over, with the same discipline, regardless of what the last trade did. Your charts get simpler. The 17 indicators come down to 3 or 4 that you genuinely trust and understand. The strategy narrows. You trade less, not more. And the quality of what you do trade improves because you are no longer entering positions out of boredom or the need to feel like you are doing something. You stopped trying to predict what the market would do. You started responding to what it was actually doing. And that one shift is worth more than every indicator you ever learned. Profitable months start to accumulate. Not every month. There are still drawdowns. But the drawdowns are controlled because the risk management is real now, not theoretical. And over time, the equity curve begins to do what you spent years trying to force it to do. It moves upward, not in a straight line, but in a direction, consistently, quietly. And somewhere inside that consistency, something occurs to you. You realize that the market was never the obstacle. You were the obstacle. And that realization, which would have felt like an insult at the first or second level, now feels like the most useful thing you have ever understood. Most people want to arrive here and call it finished. And reaching this level is a genuinely enormous achievement. For the overwhelming majority of traders, this is the destination. But there is a fifth level. It does not announce itself. You do not apply for it. You do not study your way into it. You arrive there, if you arrive at all, because the market has tested you in every way it knows how, and you are still here. The fifth level trader has been through bear markets and bull markets and the specific madness of a market that moves sideways for 18 months and grinds down every emotional certainty you thought you had. They have been through black swan events that made their models temporarily irrelevant. They have had their best strategy stop working and had to rebuild without panicking. They have experienced every version of this thing, and they did not leave. What separates them is not a better system. It is depth. The kind of depth that only comes from accumulated experience. The kind you cannot shortcut and cannot buy. Their edge is not just in what they do. It is in what they no longer need. They no longer need the market to validate them. They no longer need a winning month to feel good about their process. They no longer need certainty before they act, because they have made peace with the fact that certainty was never available in the first place. They think in probabilities the way a doctor thinks, about outcomes, not emotionally invested in any single case, but deeply committed to the quality of the process across all of them. They manage risk the way a pilot manages a flight, not because they expect something to go wrong, but because the management of what could go wrong is what makes everything else possible. The fifth level trader is not necessarily the richest person in the room, but they are the most durable. And in markets, durability is everything, because the market has unlimited time and you do not. And the only way to actually win the long game is to still be playing it. Here is the thing that connects all 5 levels. The thing that this entire journey is actually about. Each level requires you to leave something behind. At the first level, you have to leave behind the belief that trading is easy. At the second, you have to leave behind the belief that knowledge is enough. At the third, you have to leave behind the need to be right. At the fourth, you have to leave behind the attachment to individual outcomes. And at the fifth, you have to leave behind the need for the market to behave the way you think it should. Every time someone washes out of trading, it is because they refused to leave something behind. They held on to the gambler's thrill, or the perfectionist's paralysis, or the ego that could not survive being wrong, or the emotional fragility that made every losing trade feel personal. The market did not beat them. The version of themselves they refused to let go of beat them. The 99% who never reach the end are not less intelligent. They are not less hardworking. They are simply less willing to be changed by the process. And trading, at its core, is a process that will change you whether you consent to it or not. The only question is whether it changes you in a direction you chose, or in a direction you never saw coming. You started this with a screenshot in a group chat, a number on a screen that belonged to someone else. That was the door. What is on the other side of it, how far you go, which level you reach, whether you make it to the place where the process finally feels like something you own. That is entirely determined by what you are willing to become. The market is already open. It has always been open. It is waiting for the version of you that is ready.